Today, we will talk about deferred revenue, also known as unearned revenue. Today, we will talk about deferred revenue, also known as unearned revenue. Deferred revenue refers to advance payments a company receives for products or services that are to be delivered in the future. The company records the amount as deferred revenue, a liability, on its balance sheet. Deferred revenue is recognized as a liability because it represents products or services that are owed to a customer. As the product or service is delivered over time, it is recognized proportionally as revenue on the income statement. Consider a media company that receives $1,200 in advance payment at the beginning of its fiscal year from a customer for an annual newspaper subscription. Upon receipt of the payment, the company's accountant records a debit entry to the cash account and a credit entry to the deferred revenue account for $1,200. As the fiscal year progresses, the company sends the newspaper to its customer each month and recognizes revenue. By the end of the fiscal year, the entire deferred revenue balance has been gradually booked as revenue on the income statement. When payment is received in advance for a service or product, the accountant records the amount as a debit entry to the cash account and as a credit entry to the deferred revenue account. When the service or product is delivered, a debit entry for the amount paid is entered into the deferred revenue account, and a credit revenue is entered to sales revenue. Accrual accounting records revenue for products or services that have been delivered before payment has been received, which is the opposite of deferred revenue. Accrual accounting records revenue for payments that have not yet been received for products or services already delivered. Deferred revenue is recorded as such because it is money that has not yet been earned because the product or service in question has not yet been delivered. It's common for businesses to receive payments upfront, but such payments are recognized as liabilities on balance sheets because the recipients still owe goods, services, or possibly a refund if the goods or services never are delivered. Here are 3 key takeaways. 1. Deferred revenue is a liability on a company's balance sheet representing prepayment for goods or services yet to be delivered. 2. Deferred revenue is recognized as earned revenue on the income statement as the good or service is delivered to the customer. 3. The use of the deferred revenue account follows GAAP guidelines for accounting conservatism. Hope this would help. Thanks for watching.